Journal has a piece kind of interesting about a decline recently in prices for raw materials and how that has some people hopeful. If you in the text, in the body of the article, it points out some of that is coming from speculators. And we know commodities, you always got to figure out, you got suppliers and users, and then greasing the wheels, you got all the speculators along for the ride, which provide a lot of liquidity. They're great. But they also maybe skew prices either up or down. Is this speculators that are exiting, even though supply-demand dynamics have not really changed?
Absolutely, yes. I mean, financial markets are trying to price in a recession. The physical markets are telling you something really different. I want to say the liquidation in these markets has been nothing short than a very large scale. Now, but in terms of looking at the physical markets, I'm going to point this out in oil. It's the tightest physical market ever on record, as long as the data goes back. When we're looking at physical premia, the Saudis just took up their physical prices up to $9 a barrel. When you look at inventories, we're at critically low inventories across the space. You are in a 1 million barrel per day deficit when you look at the high frequency data. We're out of refining capacity. So when we look at particularly on the food and fuel side, these markets, the physical markets, are telling you something very different than what the financial markets are telling you.
Well, then that's not helpful in terms of probably overall inflation and what the Fed's going to have to do, unless you think that maybe speculators are pricing in a recession. A recession, I guess, could hit the demand side, so maybe that could be self-fulfilling. But your point is that any glimmers of hope that we're seeing right now don't necessarily mean that supplies are going to going to ease anytime soon.
Absolutely a true statement. I want to point something out, the difference between commodities and financial markets. Financial markets are driven by expectations, equities and bonds. They're driven about what the future is going to look like. Commodities are spot assets driven by what's going on today. And so if you sell the market on expectations of weakness in the future, it actually makes it more bullish because you cut back supply. So, and I think those physical markets are telling you this situation is far from over and is still very tight. We think there's a lot of upside risk near term. We still stick to our $140 a barrel target on oil. Right now, when you look at products, they're pricing in something closer to $175 a barrel. And if you take our 140 and translate it into product prices, comes in somewhere around $5.30 a gallon on gasoline and $6 a gallon on diesel. So that means you got more upside risk at the pumps, which is going to be difficult from an inflation perspective.
Jeff, the $140 a barrel forecast that you have, does that factor in the full extent and the full impact of potential price caps, of the real enactment of a ban on Russian oil, the limitation of oil equipment into Russia, all of those things that are sort of happening as we speak?
Well, it incorporates the potential or announced ban by the EU. Mm-hmm. It does not incorporate a price cap. I want to be really careful about this price cap. It's all been discussed under the assumption that the Russians will supply this oil. But there's one thing that, I just kind of take the oil and talk about the risk here is there's 10 million barrels per day of Russian oil that's being produced. You can think about, 4 of it covers the cost of the industry. 3 of it goes into government revenues. The last 3 million barrels per day is to create hard currencies like euros and dollars, and they have an asset freeze on it. So their incentive to produce that last 3 million barrels per day is really not there. And if you really put a restringent cap on it, their incentive to produce it drops precipitously. So let's not assume that oil is going to be there. And you got to think about it from the supply side as well in the incentives for the Russians to produce. And some of these price caps that they're talking about are so low and so draconian, it'd be really questionable. The other thing, too, if oil prices rally further, the price cap stays lower, the cost structure just says, hey, those barrels drop out. So I want to be really careful here that this price cap discussion is not a end-all discussion here, and it's not a perfect substitute for what the EU ban. But to answer your question, yes, we do factor in the EU ban.